Alrighty, welcome everybody. This is my April OPEX video. In this video, I'm going to be going over my thoughts for the upcoming OPEX cycle. And real quick, as I start off this video, I want to remind everyone that new trends and new cycles begin with OPEX, and old trends and old cycles in the market end with OPEX. All right, so last Friday, March 15th, was the end of March's OPEX cycle. This upcoming Monday is the beginning of April's OPEX cycle. Okay, and there is a lot to talk about as we head into April OPEX. So for starters, I want to start this video off going over USD JPY. So I'm looking at the weekly chart right now. Price is painting a massive ascending triangle going back, like this is a multi-year ascending triangle. Okay, for those that don't know, an ascending triangle is a bullish breakout pattern. It shows accumulation at swing highs as momentum builds for the next leg higher. Now, considering what time frame we are on the weekly time frame. Keep that in mind. And this is a multi-year ascending triangle. Price traded inside this triangle all of 2023. Okay, this is a lot of momentum that's being built up for the eventual breakout through 152. All right. Last week, price bottomed at a key fib level. It completed a shallow retracement to the 38.2 fib level, okay, that we can see right here, drawing this long GP using these two major swing points. Okay. A shallow retracement is only completed during strong uptrends. Please keep that in mind. A shallow retracement is only completed during strong uptrends. And if we look at this trend that I used for the two swing points for this long GP, all right, we've got a very strong trend that's not necessarily vertical per se, but it goes up in a pretty straight line. We don't really see any of these multi-week pullbacks that we see over here that we saw in the middle of 2023. So far, this is looking like a shallow retracement has been completed, which means price is now pointing back to the upside. So why am I talking about USD JPY at the start of an April OPEX video? All right, this week is a BOJ meeting where it looks like they are ending negative interest rates, a policy that has been put in place, I believe, since 2016. Okay, this news came out last week from the BOJ. Or excuse me, 2 weeks ago. That's why we see this strong sell-off lower. Okay, when the news hit the wire that the BOJ was looking at ending the negative interest rate policy, all right, the immediate reaction was a stronger yen. All right, and that's why we see the move lower in USD JPY. However, the dip was quickly bought. As we can see, once price met the shallow retracement level at 38.2, the dip was bought. There was no acceptance lower, and price rebounded. And USD JPY had a pretty strong week last week, closing just under its highs on the week. Okay. The fact that this dip was bought after the yen briefly rallied is a little bit of a bearish note in my view. Okay. And when I say bearish, it's bearish for equities in my view, and it is bullish for USD JPY. This chart, if you don't know, indicates a stronger dollar. Okay, so DXY, you can look up DXY, that is the ticker for the dollar index, and this generally, and USD JPY, is the dollar trading against the Japanese yen. So this is indicating a stronger dollar that is looking for fresh highs very recent, or in the not too distant future. Okay, if price breaks out of this ascending triangle, and I'm really emphasizing this bullish breakout pattern here with the with the supposed end of negative interest rates coming from the BOJ. Okay, if price breaks out through 152, I have 160 as a intermediate long target. I think this breakout leads to well beyond 160, but in the shorter term, this can be met through April OPEX, and it can definitely be met heading into May's OPEX cycle. If we get this breakout of this ascending triangle, we should see 160 USD JPY trade in the very short-term future. All right, so keep that in mind as I progress through this video, because I have a couple different markets that I want to go over. Okay, moving on, I want to go over TLT. All right, so bonds for years now have been in a long-term downtrend. All right, I want you to keep that in mind. for this video. Bonds have been in a long-term downtrend. Yes, there have been solid upswings. However, every rally is eventually sold off. All right. Last week, TLT's weekly candle closed as a bearish engulfing candle with a noticeable increase in volume. Now, I'm not going to show this chart, but on the daily time frame, if you want to draw this channel for yourself, TLT had a really nice descending channel going. And a couple weeks ago, we saw the breakout of the channel, and it looked like everything was geared up for TLT to rally back towards $100. If that was going to happen, that would have been a very nice tailwind for equities. Now, that is still possible, but right now, looking at last week's weekly candle, we've got a very large bearish engulfing candle with a noticeable, I'm not sure why that tool didn't work, with a noticeable increase in volume. Okay, right now, price action on a dominant time frame, the weekly time frame, is looking bearish for bonds. And thus, I'm not going to show you the 10-year chart, but if you want to look up TNX, last week's TNX weekly candle closed as a bullish engulfing candle. Okay, so bearish bonds is usually going to mean bullish treasuries. And if the 10-year rallies, it's going to be a headwind for equities. Just like falling bonds can be a tailwind, falling bonds can be a delayed tailwind to some degree. We saw that in 2022 when equities were rallying in a very strong bull market, or excuse me, in 2021 when bonds started seeing a little bit of weakness. Equities were still rallying higher to some degree. Now, when the selling sped up in bonds in 2023, obviously that coincided with the weakness in equities, and that was the start of the bear market. To some degree, bonds and equities can trade against each other to some degree. However, they are a very nice pairs trade over the long term, and generally their sentiment tends to match each other very, very well. So if bonds, or if TLT in this case, begins to trade lower and executes on this bearish engulfing weekly candle, it's going to put pressure on equities. Okay, obviously if bonds are moving lower, treasuries are moving higher, and that's a headwind for equities. Specifically, rising treasury yields is a very nasty headwind for large cap tech stocks. I'm going to go over that more later on in this video. Keep in mind, markets are a never-ending auction, and price is always going in search of value. Okay, if TLT is going to go in search of value at lower prices, if it capitalizes on this bearish engulfing candle, we're going to see TLT trade lower into this long GP. Now, I'm comfortable being a buyer at this long GP, but I'm also going to say I'm okay being wrong. So the short trade following this bearish engulfing candle is shorting down to $90. Okay, you're eyeing a $4 move lower just about, or a 4% sell-off. And a stop loss is going to be a weekly candle closing above $96. Okay, a weekly candle closing above $96 after this bearish engulfing candle invalidates the short setup. I want to make that very clear. Okay, but if sellers capitalize on this engulfing candle, we're going to see TLT move lower in search of value. Now, I do think we see a strong bounce under $90. So the short trade is shorting from current prices to $90. And this can be met during April's OPEX cycle. If sellers remain in control through April, but $90 isn't not met, it will most likely be met heading into May. Okay, so keep that in mind. Bonds for the next month to 2 months is going to be a good short trade in my view, but the stop loss is a weekly candle closing above $96. $90 is the intermediate downside target. Can it be? Can TLT move lower? Yes, absolutely. We can see price trade all the way down towards the mid to low 80s if necessary, or if treasury yields are that strong. Okay, I don't know that yet. I do have the long GP drawn because I do plan on taking the long trade under $90 once this golden pocket is met, because this is a very, very nice swing low to swing high using 2 major swing pivots. But that is a conversation for another day. So the short trade is from current prices down to under $90, and watch bonds carefully. If they continue lower, it means treasuries are rallying, and that is a direct headwind for equities. All right, so now I want to move on to SPX. All right, so real quick, I'm going to flip between the daily and weekly charts as I go over SPX. So the neat thing about SPX right now is we have seen back-to-back weekly inside bars inside this weekly candle. Okay, notice the body of these two weekly candles right here closed inside of this body from 3 weeks ago. Okay, this is showing signs of exhaustion at all-time highs. Now, when we break it down to the daily time frame, wait for trading view, we can see a balancing range has formed. And right now we are looking at a false breakout from last week. Okay, that is bearish. Unless SPX sees a weekly close back above the 3 weeks ago high. Let me flip back to the weekly chart real quick. If you are a bull at current prices, you want to see the upcoming weekly candle close above this high right here, or this closing price of this weekly candle at 51.37 SPX. Okay, that invalidates the distribution thesis on SPX right now. And I'm going to be honest, my bias right now is to be short. I think we're seeing distribution at all-time highs, which is natural. It's only a part of the market cycle. Okay, if you're a trader, you have to be willing to adapt to the long side and the short side. Okay, I think we're seeing distribution right now, but what invalidates the short thesis is a weekly candle closing back above 51.37 and breaking the trend of the last 2 weeks where we've seen two inside bars. Okay, however, that is the line in the sand for the short trade is 51.37. But my bias heading into April OPEX is bearish. So I'm going to approach this upcoming OPEX cycle from a bearish point of view. We're going to see sell the rips return as the new theme. And what that means is you want to be shorting or positioning yourself short on any low volume rally that we see. If we see a 2 to 3 day or even a 1 to 2 day rally or an attempt at rallying and it comes on low volume, buying or shorting the close of those green candles on low volume is the high probability short trade to position yourself short with time, eyeing lower lows. Okay, so if that doesn't make sense, I'll try and word it a different way. If we get 2 to 3 green daily candles that close green, and if they all come on low volume, once we get that second or third green candle that closes green on low volume, short into that close and position yourself short with time. Time will be your friend during corrections because eventually the move lower is going to come. It's going to be sharp. It's going to be swift. But because you're positioned with time, you're able to ride out any consolidation or theta decay that the options will see before the actual sell-off is given. Okay? So the downside target for me for SPX, and this is a conservative target, I think SPX can definitely continue lower through April OPEX, is 49.84 SPX. That means this daily bull gap is filled. Okay, this is the conservative target, 49.84. Now, once this bull gap is filled, we're probably going to see a bounce. Any bounce from 49.84 into 50.50, I want to short again, eyeing fresh lows, somewhere towards 4,900. Okay? Now, if April OPEX, if sellers capitalize for April OPEX, and they capitalize on filling this this open bull gap, we're probably going to be seeing the start of a correction. And I think this correction will be a multi-month correction. And I want to show you why I think that. So I'm going to go ahead and delete this here for the time being because I don't want my chart to get too messy. See this level right here, 45.54? That's going to be an important level as I go over what I want to show you. All right, so 2023 is shaping, or was a very nice year for the markets, and 2024 is shaping up to have a similar trend. Now, let me show you what I mean by that. So, actually, I'm going to flip to the daily chart. I'm trying to remember what chart I did this with earlier for my weekly plan, and I realized it was the daily chart. So, it'll look cleaner on the daily. So, 2023 had a very strong 5-month rally. I'm going to change colors here real quick. So this was a very strong rally through almost half of 2023. It lasted for right around 5 months, okay, and it was a monster of a rally that was a 21% gain in SPX off the swing low for this rally here, okay? 21% gain, lasted for 5 months. However, eventually in the summer of 2023, it topped out, and the market underwent a very solid correction to lower prices. And excuse me while I fill in these boxes here to show you my line of thinking. So the correction that followed this 5-month rally was a correction of 11%. Now, obviously, this correction led into the very strong rally that we're currently in right now. And it went on to see SPX make fresh new all-time highs, and so far it's knocking on the door at 5,200. Okay, I want you to take note of the time that each of these two phases of the market took place, or how long these two cycles took place. We have a 5-month bull rally, or bull market rally. And that's followed by a 3-month correction that erases about half of the move seen in the previous 5-month rally. So now looking at current prices. Oops, let me draw over here. We're again looking at another near 5-month rally to new all-time highs. This time, oh, I see what I did there. Let me switch these around real quick. All right, so this bull market rally that has led to new all-time highs off of the October 27th swing low, I believe that is the date, has led to a rally of 26% so far. See the similarities here a little bit? In the summer, or excuse me, this was in the beginning of 2023. So the first half of 2023, we saw a 21% rally in SPX. So far, from November basically to the beginning of March, we have seen a 26% rally, right around 5 months. See the similarities here? So under this line of thinking, in my view, if April OPEX, if sellers capitalize on the window of weakness, that is this week, the first week of April OPEX, that is the window of weakness. If sellers capitalize on this, I think it can mark the beginning of the next correction in the market, and it will be about 2 to 3 months long, just like the correction we saw in the late summer to early fall of 2023. Okay, now let's draw out the same path. Let's look at a 10 to 12% correction in SPX from current prices, and let's see where that gets us. And I do have a target, so I am being biased here. And I'm going to draw out to June OPEX, which is the 21st of June. And I do have a target in mind, and that's why this level is marked right here. And I'm going to change this real quick. All right. So if SPX begins a correction, it's probably going to be the same amount of time that the previous one was, which is the thesis that I'm operating under. Now, what did I say earlier in this video? Price is always in search of value. We have poor structure to repair at lower prices looking at 2023's profile. Okay, see this massive volume gap right here? That was created during this breakout that we saw in December. Now, the breakout was fine at the time because it was a 2-week balancing period that led to that sharp move higher. But either way, that move higher creates a volume gap. Poor structure loves to be repaired, and generally, poor structure is always repaired in the market. It just takes time. You can't really put a definitive time on it. All I can tell you is that poor structure is inevitably going to be repaired over time in the markets. My short target for this possible correction cycle is 45.54. That is SPX returning to 2023's VAH, or value area high. Okay, if you trade with volume profile, you will be familiar with these terms. If you're not, it's not hard to learn. I do talk about them regularly in my server. If you do want to become a member, I do go over volume profile on a weekly basis for my team. Okay, so this is my time frame for SPX, and this is what I'm looking at into the end of quarter one and into the beginning of quarter two. I think we're gearing up to see SPX enter a correction, and the termination point, as I said, was a new SPX weekly candle this week closing above 51.37. That breaks the 2-week balancing period, and that puts 5,200 back in play. Okay, that is the termination point or termination level for my short thesis. Okay, so long as we don't see that weekly close above 51.37 SPX, Risk is to the downside at current levels. Bears can capitalize, and a multi-month correction can be seen. People will scream from the rooftops saying a new bear market has begun. I don't believe that one bit. Okay, bear markets occur like once a decade, right? We've seen our bear market potentially for this upcoming or for this new decade, the 2020 decade. Okay, this is a simple 12% correction that is very healthy in the long term. And if this is completed, I think SPX can print 6,000 before the end of the year. Okay, that is just me thinking out loud here and being very loose in my estimates. But if buyers defend this 45.54 level, which is a very important volume profile level, and if this 12% correction is completed, it does set up a very, very strong second half of the year for equities. Okay, and we will see the early favorites this year, chip stocks, Microsoft, Facebook, or Meta. Okay, those names will be even bigger winners in the second half of the year. NVIDIA can easily trade, I would think, into 1,200, 1,400 into the end of the year following this correction, or this 12% correction. Okay, and it does sound severe on its face value, and like 12%, oh my gosh. Okay, keep in mind, 20% drawdown is the beginning of a bear market. Okay, SPX can absolutely move lower, under 54.54, or excuse me, 45.54, and it still doesn't enter a bear market. Okay, it's just a deeper correction. And we saw a really deep correction in, I think, August or September of 2021. That was the last part of the very strong bull market post-COVID lows. And I think QQQ technically entered a bear market while SPX underwent a deep correction. And then as soon as QQQ began a bear market or hit like the unofficial bear market level of a 20% pullback, it reversed right away and equities were at new all-time highs within a month and a half. Okay, so don't feed into the drama and the perma bears screaming from the rooftops if we do get the scenario playing out. This right now is my base case as a trader, and I'm a swing trader at heart, and I love looking into the longer term picture and forecasting. So this right now is the forecast that I'm operating under as a trader, and I am looking to pick up naked VIX calls this week, this Monday, tomorrow, as a long trade, eyeing this correction. Okay. Last but not least, I want to pivot to Apple now, and I want to go over Apple real quick because I think this is the stock that can either seal the deal on the upcoming correction, or it's going to stave off the correction for another month, and it will be the bull's saving grace. So looking at this weekly candle right here, it closed as an inside bar. I just showed you inside bars with SPX. Apple has the same thing from last week's auction. Inside bars are a sign of consolidation or balancing before the next big move occurs. Okay, so take note of where this inside bar occurred. It occurred at 2023's VAL, or value area low. This is a monumental support level, and it is a major pivot level, or excuse me, the 169 is 2023's VAL. So this is a major, major pivot level. So far, 2 weeks in a row, buyers are defending it. And last week's inside bar is a decent sign of hope for bulls, hoping that the kingmaker, or Apple, I like to call it the kingmaker, folks in my team know that. Sorry if that confused you. The kingmaker is looking to put in a swing low at a very key pivot level. Okay, so the bull case for Apple and then thus equities, because let me tell you, if Apple rallies, SPX is not going to see a 12% correction. Okay, if Apple is going to rally, it's going to be very, very hard for sellers to capitalize through April OPEX. Okay, so the bull case for Apple and thus markets is buyers capitalizing on this inside bar, and a weekly candle closes above this high at 176. If we get a weekly candle either this week or next closing above 176, it puts 183, which is so far 2024's point of control, as an intermediate long target. That's the upside target that can be achieved if this 169 level holds through April. So if 169 support holds through April, 183 can be met through April, OPEX. I'm saying the month or the word too much. Longer term, through the end of this OPEX cycle, I believe we can see a return towards 192 in Apple. That is the bull case for April OPEX. The bear case for Apple is this 169 support level failing. If this support level fails, it is going to kneecap the markets with it. That's going to kneecap SPX. It's going to kneecap the NASDAQ. And we're going to see this poor structure repaired. There's a reason buyers are fighting like hell to defend this level. They do not want to see 169 fail, because if it does, there is no value at lower prices from 2023's profile to support a bounce. And that means price is going to search very low for value. See 2022's point of control right here, 146. That can act as a magnet for Apple if this 169 level fails. Okay? Keep this stock on watch this week, because Apple can either save the market from a correction for another month, or it can kneecap equities or kneecap the indexes with it. And this correction starts with fireworks as Apple goes in search of value at much, much, much lower prices. Okay? So last but not least, I want to go over FOMC notes, because this week we have FOMC. Rising commodities. Gold has seen a new all-time high. Oil is steadily grinding higher, although in my view, I trade oil every day basically. I don't like the breakout in oil. I think it could be much more constructive. It could be more healthier, but price does not lie. Oil is seeing fresh highs. Okay. Commodities, rising commodities, and a hot economy. We just saw a strong NFP report that was very hot. A hot economy and rising commodities put pressure on equities. And they do not want, or the Fed does not want to cut rates while commodities are rising. Okay, so keep that on watch as well. A possibility this week with FOMC is the Fed kicking the can down the road. Does the first rate cut come in the second half of the year versus the first half? Okay, that is a possibility. We don't know if it's going to occur. We'll find out on Wednesday from the Fed and Powell himself, but that is a possibility to keep in mind. If the Fed kicks rates or the first rate cut into the second half of the year, that can lead to a bearish reaction in equities, because let's be honest, this rally in equities that we've seen through 2024 so far is built on the idea of the first rate cut coming sooner than later. Okay? Last but not least, why does the Fed want to cut? In my view, there is stress in the banking system, quote unquote, under the hood, that the Fed does not want to get any worse. Okay, we saw New York Bank Corp, I think it was the name of it, fail just in the last month. Okay, in 2023, we saw 3 bank failures. So we're up to 4 bank failures now since the Fed started hiking rates from 0 to 5% in less than 2 years. A very, very aggressive hiking cycle. Okay, all is probably not well under the hood for the banking system. The Fed wants to cut to start alleviating that stress as soon as possible, but markets or equities at all-time highs plus rallying commodities is not helping the situation one bit. Last but not least, it's an election year. President Biden is making comments that the Fed is going to cut rates. That is nearly all but certain that the Fed will cut rates. It's just a matter of when. And more or less, I think Powell is looking to get, how do I word this? Powell is looking at getting elected officials off his back with higher interest rates. His life is easier with lower rates. Now, we're not going back to the COVID rates of rates at 0, but I think in the longer term, lowering rates or getting the terminal rate under 4% is probably where we're going. All right. So everything I talked about in this video is my notes for April OPEX. If you found this video interesting, or if you found it valuable, if you learned something, feel free to like it and subscribe to my channel. And if you have any questions for me for anything that I went over, feel free to leave them in the comments below. I respond to every comment. And with that, I hope you guys have a great week ahead of you in the markets. And if you're interested in joining my team, I will drop my Discord server link in the description below. Have a great week.